Great. Thanks. So again, the topic here is communicating value to the C-suite. So really kind of starting off with why the topic. And as I was preparing for this, many of you might have seen this, this quote before. And I'd seen it several times and used to think, you know, I agree to this. You know, your value doesn't decrease based upon somebody's inability to see your worth. But as I was preparing for this, I go, or does it? And as I was thinking about it, what I really realized was, I think on a personal level, I agree with the statement. You know, you might have different values from somebody else. And so if somebody doesn't see, you know, the values the way you do, it doesn't diminish your value or your worth. But on a business level, I think it's different. So I kind of came up with this quote. And I feel like your business value is directly proportionate to the value that the C-suite sees in you. And so that's really about the topic today is, you know, kind of understanding what's that value and how do you, there we go. So what's that value? How do we create value? So I've got a great group of panelists here. We've got Norm McLeod, Geno, Coradini, and Singh, and I'm going to let each of them introduce themselves to you real quickly. Norm?
Okay, I'm Norm McLeod. I'm at home. We have 50 some odd stores. We'll have 100 stores by the end of October. We had 50 stores a year and a half ago, and we'll have 100 by the end of October. Previous to that, FedEx and then Yum Brands.
I'm Geno Coradini. I'm Vice President of Real Estate for Advanced Auto Parts. I've spent nearly 20 years in the industry, and I've worked also as a consultant with JLL, working with Steve, and I've also worked in-house with a number of different retailers. We have just over 5,000 stores nationwide. We're continuing to grow at a pretty rapid pace at about 100 stores a year, so lots of activities.
Hi, I'm Singh. I'm the Chief Development Officer at Bloomin Brands, which is Outback, Fleming's, Bonefish, and Carrabba's. We have about 1,500 stores. Prior to that, I was the Chief Development Officer at Darden, which has about 8 concepts. I won't go through them all. And prior to that, I was the head of real estate for Burger King North America. So built a few restaurants over the last 20 years.
And I realized just a few minutes ago, Sukh's a very important person to meet because he's got a lot of connections in the wine industry up here through his restaurant brand. So he's going to become my newest best friend. So again, the topic's communicating value to the C-suite. So what we've done is we've had several conversations coming up to this event, and just internally kind of brainstorming, you know, what does this mean? And so collectively, we kind of came up with 5 things that you'll see here that we're going to talk about. Now, each of them are going to give you a few ideas behind that. It doesn't mean it's an end-all solution for every one of these things. It's just more some brainstorming, just some ideas that each of them had that they can talk to you, and hopefully you'll have a few takeaways that might be of value to you. But before we get into that, I kind of I started to put this together and thinking, you know, what is value? And so, you know, on the one side, I go, what's Wall Street looking for? And the whole purpose of that is the C-suite, and I'm saying that really the CEO, CFO, you know, they're really focused on creating shareholder value. And I'm referring mostly, obviously, to public companies within this. But, you know, they've got certain set of things like year-over-year revenue growth, you know, margin, maybe EBITDA, earnings per share. Those are the type of things that they're thinking of. So that's exactly what the CEO is thinking of. That's exactly what the CFO is thinking of. So you look at that side. Then you look at the other side, kind of the other stakeholders, and we're there to kind of support those goals and objectives, what the CEO is trying to do. So it could be, you know, how many new stores opened, increased store openings, things like that. And those are sort of above the line. Then I put below the line is more intangible things like customer satisfaction, employee satisfaction, that we all have to have, but it's not necessarily a direct measurement. But again, all of these things are done in order really to kind of focus on what's important to the CEO and the CFO, which to them, again, is important, you know, really to the analyst. And so just take that in mind as we're kind of going through some of this right here. So the first one of our 5 points here today was determine what is value. So we're going to, Norm, you, as we were talking through, you talked about engage the entire business. So talk about that a little bit.
Well, you just showed that, you know, what's important to the C-suite was the stuff on the other side. You know, first thing is, you know, for me to be a good leader, I have to really know what the overall objectives are for the company. And it's also better, you know, because you're more involved and more engaged in it. You want to know what the revenues targets are, the profit targets, same-store sales, how that growth is going to occur. And we want to know what the marketing objectives are, what the timing is, how much the spend is going to be, and you know what dollars you can use for your initiatives. Plus the timing may affect what you might do with your team. You want to know the operations experience that we're trying to deliver, because you know the stores that you build are a big part of that experience. And I'd say that you also need to be really engaged in the culture that the company's trying to build overall and drive that same culture. So for you know, really to create the value, first of all and foremost is what's the overall company looking for? What are the CEO and the CFO looking for? So
But I think the important thing is we're talking through this, you know, it wasn't just looking at real estate goals. He spends time understanding operationally all the other components that looks at the whole picture, you know, for the organization.
Yeah. And then you would have input into those as well, which makes the job funner.
So Geno, you talked about listen, but don't just agree.
Yeah, absolutely. So I've been with Advance Auto now for going my second year. And I mentioned that I've been in the industry for a number of years, working with several different retailers. And each one's a little bit different. It oftentimes becomes less about the real estate and more about just the fundamentals of understanding how to lead an organization and understanding what the CEO, the CFO, and what their vision looks like, and being able to execute on that. And I think it's critically important to understand where those pain points exist. I mean, let's face it, Advance Auto has been around for over 80 years. They don't need me to be successful. They've opened hundreds of stores. And I think it's important to first, as you just ramp into an organization in a high leadership role, that it's very important that you're listening to understand and seeing where you can add value early. Oftentimes the CEOs, CFOs will have these grand plans, grand ideas, and you sometimes feel obligated to agree with them, or shall I say, go along to get along. And they've hired you for your experience, your expertise. They're not expecting you to boil the ocean necessarily. They already trust that you're the right person. So don't feel that you always have to go along to get along. Leverage some of your past experience and knowledge to share with them and to be able to add value. And if they have a suggestion that's clearly off base, you have to be strategic enough in how you tell them that it is a little off base. But it's very important that you listen and to understand the vision of the organization.
So in essence, it's not just to be an order taker, you know, just kind of tell me what you want and I'll go do it. It's, you know, to provide feedback, and sometimes that might be a little bit different from their vision, but they're using your expertise to maybe come up with a different vision.
Right.
So Suk, you talked about different things to during different times of the cycle. So
yeah, let me just start off by saying, if you're presenting or meeting with the CEO or CFO on a Monday to Thursday, you dress like this. If it's a Friday, you can dress like this. So I told them I'd have a go at them about that. No, by different things at different times. I mean, if anybody, and I'm sure you all have been in the real estate industry for the last 10 years, 2007 was a very different time to 2009. And what the CEO and the CFO wanted from you in 2009 was so much different than 2007. In 2007, it was, how fast can you get these open? We've told Wall Street we're going to deliver a plan, and you're going to deliver it. In 2009, it was, how can you save me some money? As much money as you can save, I want it. And you told them what you could save, then they wanted 20% more. So I think that's the macro industry. And then when it comes to your individual company, every company is at a different place. So you need to understand where you are in the marketplace, what you're delivering, and how you can communicate different things during different times. And value at those different times means different things to the CEO and the CFO.
So I came across this quote as I was looking at. It's not hard to make decisions once you know what your values are. This came from one of the Disney brothers, and I think that's what we're talking about. Is you've got, first of all, you have to understand what's important. Each one of them has talked about that, and then from there, then you can create a strategy, which is kind of taking us into the next part of this. But I felt like this was kind of a graphic to kind of look at. Again, it's not just one of these. It's not just a real estate strategy. In order for success, it's the overall business unit, the corporate strategy, real estate strategy, and operational strategy. When those things come together, and sometimes you can have conflicting ideas, about that. So think about this: if the operational side is focused on revenue or their margin of that, could be conflicting to when somebody on the real estate side says, hey, we need to have a maintenance plan put in place, that we're proactive on that. You're spending some money on the one side. Operationally, they're thinking, I don't want that to eat into my margins. But long term, you've got to know that you're in the business for the long term. So sometimes they can be conflicting values, and you need to be able to come together, really as a team. So the next, develop strategy for creating value. So we understand what the CEO, CFO wants. So next is creating a strategy around that. So Norm?
Yeah, it's not one of at FedEx we were really focused on long-term planning, and I really saw the value in my experience there. But it's not just about setting up what you're going to do this year. It's about what you're going to do over the next 5 years. And the executives want to know that you're thinking through the whole, not just how to deliver 20 stores for this year's opening, but how do you support them? How do you have processes and resources in place to open up the stores? And then you can also at that time, quantify the value that we're going to create not only in the next year, but in the out years. And I think if they see a holistic plan like that, that helps them feel more secure that you've really thought through it. And at the same time, it helps you really, you can go in at one shot to figure out, what's my organization going to look like, what are my process needs, and then just execute against the plan. So both short-term and long-term plans are essential in my perspective.
Okay. Geno, you were talking about kind of translating the vision to the team.
Yeah, kind of segueing from the listening piece, I think it's critically important that once you align on the strategy, that you communicate that strategy effectively. In particular, if you have people managers that report directly to you. You'll see far too often that when there's lack of alignment with management, people are confused and people kind of check out and think that you're not being transparent with your direction. So it's kind of a saying, team together, team apart, I think applies when you're in an aggressive growing organization and you're moving at a very, very fast pace, that the team has alignment and that everyone's kind of speaking the same language once you've developed that strategy.
All right, Suk, you talk about it's not just about growth.
Yeah, I think too often when we talk about value, we always kind of go to growth because that's the most easily seen, but you yourself have to look at yourself as the leader of 6 or 7 different departments. So anywhere from strategic planning, how can strategic planning help in the rest of the company in terms of marketing and other departments, to asset management, to design and construction. I mean, we have a lot of partners here today who are going to help us, design restaurants and design retail spaces better than we have before, and a lot of the time cheaper than we have before. So it's about design and construction as well, and seeing how you can get value out of those departments and not only think about the growth piece.
So I think ultimately the important part of this is, you as in each of these guys being the lead of their organization, they're not the ones going to do that. So they've got to create that strategy, push that down to their team, but the teams have to understand that. I feel like too many times when we're working with companies, once you get out of kind of this level, sometimes the people down below don't really understand I'm delivering a project, and they don't really know what that means and how that really relates back to the bigger vision. So as these guys have kind of talked about, being able to take that, push that down to the team, so they all know and understand what they're really trying to accomplish and their objectives. So it takes us into the next area is really kind of around KPIs. So it's really developing KPIs. So again, we understand the strategy, we've developed a strategy. Now we've got to create some KPIs in order to kind of monitor that. So Norm, you want to talk about?
Yeah, and once you've set your strategy, as you say, and you set the KPIs for the team, you want to, in my opinion, you want to make sure that they're crystal clear, and there's 4 to 5 of them, and everybody knows exactly what they are and how they're counted. And then you translate those 4 to 5 objectives throughout the rest of the organization, but they can all tie them back. And I'd say not only for internal resources, but for external resources as well. If we have a quality measurement, the outsourced partners would also have an element of that to it, and that they would carry the same KPIs. But keep them simple, make sure they translate throughout the rest of the organization.
So I think, Geno, yours interesting, particularly being fairly new to the organization. You kind of had to start and create a baseline. So
yeah, absolutely.
Let's talk about
I think a baseline is important. I'm responsible for design, construction, market research, real estate, lease administration, facilities, and there's a lot of different things that are going on, as you all know, in each of those respective areas. And so it's important to first understand, I think, what we're doing and is it successful? Is it optimal? Is it effective? Is it efficient? And so early on, we've developed a baseline just to kind of level set, as opposed to saying, okay, these are your costs or expenses over the last year or so, and we need to reduce these by 20 or 30%. So kind of being somewhat more of the mindset of let's set a baseline, and then let's work on that to improve it over time, and then set realistic goals and even stretch goals. I think stretch goals are important as well. So we're looking at everything across the pipeline relative to our expenses, to new construction, collapsing cycle time, all of those different things, so that we then develop a more solidified key performance indicator process.
So you couldn't just accept, day one, you coming in there, CEO says, hey, I need you to do this. Well, it's like, well, I don't know where our baseline is. So that's a little bit of pushback. Hey, let's go establish where we are, and then let's kind of work towards, jointly working towards some goals.
Right. And they have a number, right? And
Yeah.
you don't just want to accept that number. So it's important to establish that baseline and understand it so that you are setting realistic expectations, not only for your team, but also to educate the C-suite so that they're understanding what's achievable and attainable.
So you talked about the benefit of measurement.
Yeah, I think it's true that they say, when they say, if you measure it, things will get better. And the challenge when measuring when it comes to our industry is making sure you have clean data. I mean, a lot of the time when you're taking big projects and trying to measure them, things can get put in the wrong bucket, and all of a sudden you think you're way out of control on one side and doing really well on another when you're not really. So making sure you have very clean data when you're measuring success or KPIs is important. And I think that's where you need the help of the finance team to really get down into the numbers and make sure that what you're reporting out is actually accurate.
Mm-hmm. So kind of the next, we've kind of developed some KPIs. Now we've got to be able to measure that. But I think one of the biggest challenges that I see with so many companies is how do you capture that? Being able to have data or information. And if you look at it, really the left side is just a bunch of dots. That's just kind of information or data. But that doesn't do you any good until you start to connect the dots, and then be able to take that and be able to summarize that, into something that's useful, that then you can translate and communicate that, both internally and upstream. So we want to talk about how are you going to use data, really to measure success. So Norm, you talked about kind of from a quality standpoint.
Yeah, I mean, we were on the phone. We were comparing notes on what do we track and how do we make sure data are driving the results, and we can tie it back. And one of the challenges that we experience at Yum Brands as a shared services is really driving the quality of execution, not the quality of the product itself. Really, it was about the quality of the execution. The operators were our customer, and that was a very important part of how the projects were received. And I just say, I saw that being very successful for us. We had an operations survey that went out, that very simple, 5 to 8 questions, about were people responsive? Did they get the punch list done on time? Did they follow up on outstanding items? And it was just really taking something that had a lot of ambiguity to it and making it real and using it for a measurement that drove success. And then at the same time, we had executives that, I remember there's an instance where a high-level operations leader came out and said, hey, we have all these problems in Houston. Well, I just took those surveys and I laid it out and I said, well, here's what they said. And they're not saying that there's any problems in Houston. So we were able to quantify that with that type of approach. So I think quality and quality of delivery is an important part of measuring success.
So Geno, you wanted to talk about trends.
Yeah, I think trends are important to understand. I think oftentimes in our industry we get hung up with trends that might not really be true indicators. By way of example, we look at market type, major metropolitan area, urban area, suburban area, and how we perform in those areas. We look at the competition, whether we're first in market, second in market, third in market to the competition, to understand a little bit if that has any impact. We look at site characteristics, full access, visibility, road sign, and a lot of those things are hard to quantify and put an actual revenue number on each one of those characteristics, but it's important to understand them so that you can make better decisions as you're continuing to open new stores. Many of you have seen discount dollar stores, for example, open at a clip of 300 to 500 new stores a year, only a decade later to say, you know what, we're going to close 700. And as you're opening at that aggressive of a pace, you can easily contaminate your portfolio if you don't really understand those trends. So it's critically important to understand those trends.
So if you kind of go back, just your analogy of opening, 500 or whatever, and then closing some, it might have been a metric that real estate or somebody said or heard, hey, need to open new stores. But if you're not opening profitable stores, that's kind of where it gets back to operationally, real estate, all of those have to kind of go together.
That's right. And retailers traditionally don't like to close stores. And it's some major event that forces them to change that mindset, such as you're lagging on your op income and your top line sales are flat. And oftentimes when you have a portfolio of 5,000 stores, it's either labor or rent that are likely your two greatest expenses. So those are often scrutinized, and you've really got to look into those trends and make sure you're making good decisions opening at such a fast pace.
So let's say, a measurement, are you looking at revenue as a % of cost, whether that's lease, capital, thing like that? Is that a metric that, I know, Suk, we were kind of talking about that earlier. It's not just about the cheapest piece of property or that. I might be able to buy a better piece of property, pay more for it, but I'm getting much higher, revenue on it.
Yeah, I think when it comes to looking at your dashboard and looking at data, you have to make sure you're looking at the right data. And the challenge is, even say when I was at Darden, we were building 100 restaurants a year, it's difficult, even with 100 restaurants a year, to say you have enough data. Because when you're looking at it, not every restaurant's the same. Some of them are freestanding, some of them are in line. They're all in different parts of the country. So a restaurant in New Jersey is going to be totally different in cost than a restaurant in Florida. So you can't compare and contrast the two. So you have to have enough of a database to kind of say, is it valid? And that takes time. So when we were using data, we would use a 4 or 5 year history to look to see, well, what was the last restaurant built in New Jersey? And maybe it was 2 years ago, and if you add on some inflation to that, or maybe not, and say, well, what's the cost now? And try and understand how regionally you were performing in terms of cost, and the same with rent. You look at rents in the Northeast and you try and compare them to rents in Florida. If you did that, you'd only be building in Florida and you wouldn't be building anywhere else. But you have to look at then what your sales to your investment ratio is, and your sales to your rent basis. So in New Jersey, you may be getting sales of 50% more than in Florida, and that may be the right decision to make. And in terms of using that history, you've got to kind of use that as a guideline to say whether you're making progress or not, and it can lead to some kind of rather robust discussions around what you're doing and how you're going about growth.
And one of the things you had mentioned also was, don't focus on the outliers. focus on the 80% of the large, or where that's really where you kind of focus your time and attention. What is that telling you versus the outliers? That those are more one-offs.
Yeah, I think it's important to focus on the core. We've all made bad decisions in site selection for sure, and I'm sure we'll make a few more along the way. But I think we need to really understand the fundamentals that make our business vibrant. Right now at Advance, our target primary focus is a 12% operating income. And so we've got some work to do around that. And there's really only a couple of levers. It's the expense and the top line revenue. So, sales fix a lot of things. So you've got to keep the business growing, but at the same time you have to be mindful of those trends. You look at everything from maturation rate to trends as Suk touched on relative to the economy. Right, in 2007, 2008, we were all competing, probably everyone in this room, for some of the same sites. And then in 2009, 2010, we couldn't give them away. But it has created a tremendous opportunity as many retailers now look to cut that cost, that rent cost, out of their portfolio because they were paying rents at the peak of the market. And frankly, they're paying over market today in many respects. I think some of that gap is closing, but I think it's also opened the eyes of retailers who, years prior to the recession, many retailers were more focused on simply just hitting that option notice date so they didn't lose the store, never really thinking about leveraging that option notice date to truly drive down costs. So it's really been quite a trend in that respect in our industry.
Yeah, I saw Bruce shaking his head. He's like, yeah, they got 10,000 stores. They don't need all of them. Obviously we've kind of gone through a process of understanding, trying to understand the value, all the way to getting some data. Now it's at a point that you got to be able to report, on what's your success. And, it's probably progress. It's not a one-time deal, but we're going to spend a little bit of time, each one kind of telling certain things that they do, in this process to be able to communicate and report on the progress and success.
Yeah, so when we talked about this originally, we were brainstorming and said, well, how do you really interface with the CEO, CFO, and in my case, the board? We had a lot of interface in my new job, not the FedEx board, but at home. And so I just threw out some terms, and it's really about how do you manage them and how do you work with them where you can build a level of trust. And obviously you got to drive for the results. If you're not delivering, you're not going to get into the position to, like where we're at right now, but you also, everybody here has got a strong drive for results, and we all get it, because if you don't, you don't stay in this industry very long. But just some of the anecdotal stuff is, I like to market the team's successes, look for short wins, look for ways to catch them doing stuff right and share it. And then if there is a problem and they solve the problem, then market the solution that they did on that problem. It could have been a problem for the CFO, and then when someone solves for it, then market that solution. I think we all said be transparent, and that was interesting when we were going through this exercise. And really, to me, it's like, if you think you should tell them something, you probably should, and never leave anything out there. And don't have any hidden agendas, because that'll only drive down their lack of trust. And they need to know that they can trust you, and your word goes a lot longer if you don't do that. And then we talk about anticipating concerns. I've got my CEO, my CFO has hot buttons. We may have a concern with a particular project that that we want to make sure we have a certain payback threshold. Well, I need to anticipate that could be a problem for a project that's very good. So at the same time, I anticipate that might be a concern. I'll bring in a project that has a really good payback and bring them in at the same time. So. Managing perception. Early on in my career, a leader told me, hey, you got to manage perception. You got to pay attention to what's going on. They think you're from Abilene or something like that. And I said, well, perception doesn't mean anything. It's all about results. And if you get 10's 10 and that's all that matters, well, that's wrong. I mean, you're constantly managing perception, and there's nothing wrong with it. But you got to be aware of it, and you got to share, be able to address it and make sure that you can, influence how people think as well as what the results are.
I'd say another thing we didn't put down here, but Norm, when we were talking, you say you even spend time with them socially, so it's not just a business relationship. Why don't you touch on that? Because I think it's important. It's about building that relationship and trust.
Well, and so many times we're in a situation where we've got to deal with something difficult, with that group. You know, it's a lot of, when things are going well, that's the easy time to report when the charts are going up, But when it's a time of difficult, you really need to have that connection. And the only way you get it is, spend time with them in an environment that's outside of the workplace. Go to lunch. David Novak said he always, managed the time with not the person he worked for, but the person above that person to have that relationship. So then when you do have a situation that you have to deal with, you at least have a common rapport and an understanding of how your personalities really match up.
So Geno, give us your thoughts here.
Yeah, so reporting on progress and success, I think it's important, again, kind of sticking with the idea of being new to an organization. I don't think you have to go in and overhaul the entire process, the entire organization. There's people there that are smart, they've been in the business for a long time, but it is important to get some quick wins. And there's a lot of things you can do without overcommitting and spreading your resources too thin. One thing that I focused early on was collapsing cycle time. And I know many retailers out there today continue to struggle with opening the majority of their stores in the fourth quarter. It's tough, it's around the holidays, people are out of pocket, so it makes it much more of a challenge. Not to mention you miss the sales weeks, which is a huge challenge for many organizations. So bringing in some of those innovative, new ideas, like many retailers have a tremendous amount of teams that have a lot of tenure, and that's good. They know more history about the organization than I'll ever know, and that's great. That adds a lot of value, but it sometimes can hinder your ability to think about things differently and be innovative and be creative. So those are some of the things that I think are important, and kind of stemming on Norm's comments about being transparent and being open and being honest and being engaging, I think are absolutely important to success, because I don't think people will follow and join your vision, if you will, as an organization if you're not transparent, if you're not open. And sometimes, we get caught up in the company line, whatever that might be for your respective organizations, but the company line is not always the line that you should deliver, in my opinion. And so I think it's very important in that respect to be very open and honest with your team members. And then the last piece, solving challenges. As we talk about communicating with the C-suite, we grow up thinking that the president, the CEO, the CFO, those are the ones that know it all. They have all the answers. But the truth is, as you mature in an organization, you're better served by not bringing a problem to one of these C-suite, CEO, CFO, et cetera, unless you have a solution. So it's very important, I think, and I've learned this along the way, that you want to be transparent, you want to share with them that there are challenges, there are problems, there are opportunities, but it's critically important that you have a solution, or at least a recommended solution. Because if you don't, and you ask for one, you might get one that you don't like or you don't agree with, and then it creates that debate. So I think it's an important note to always have a solution or recommend a solution when you come across a problem or a challenge.
So it's interesting, Geno, you talked about you thinking the CEO or CFO, they always know all the answers, and had a similar situation. Years ago I read Howard Schultz's book called Pour Your Heart Into It. And it really hit me that if you read his book, he didn't know everything. What he did was surround himself with smart people. And so, each of you are part of that. So those smart people that they're looking for your advice, so that they have a vision for what they're going to do, but they don't know everything, and they need your advice just like they need other people's advice around operations, HR, all these other things. So you are part of that knowledge base that is coming, into the CEO or CFO. Suk.
Yep. I think we touched upon the first point already in terms of looking at trends and not outliers. I think it's very easy when you look at data to say, to take the 100% of the data and go, this is what's happening in the business. And that's not really what's happening in the business, because if you take the outliers out, you might get a totally different result in terms of what's really going on in the business. But it's important that we agree what those outliers are. I've had some experiences where you know, you get reported this is how well the business is doing, but they forget to include 30% of the results, and that's not really how the business is doing. That's just excluding 30% of the restaurants that aren't doing well. Transparency, again, touched on it before. It's very, very important in terms of your relationship with the C-suite, because if you don't have transparency and you're not completely honest with them in terms of delivering results, you'll lose that credibility. And once you've lost it, you're not going to get it back. It's done. You're done. Thirdly, I think it's important, both CFOs and CEOs who are primarily talking about don't have a lot of time. So when you do get time with them, it's important that you know what you want to discuss with them, that you get your points across to them, that you not only bring a problem to them or explain what the problem is, but you bring a solution or a suggested solution as well to them. Because if you go in there and go, this is a problem, the first thing they're going to ask you is, well, what's the solution? You're the expert, so you better have a solution.
Yeah, so as we talk, they all have ADD, so we have to recognize that.
Yeah, it's about 6 minutes. After 6 minutes, you're done. Yeah. And then managing perception as well. Often they hear stuff anecdotally, which then sits with them. And so in terms of looking at data and having KPIs and having a dashboard, it's really important that you can take the information that you have and report it succinctly to the CEO or CFO. And having that dashboard really helps. And it's really important how you report out with that dashboard. So having a central reporting entity. So with multiple brands, in the last 2 companies I've worked with, it's important that a central finance function looks at that data and says, yes, that's the right data. Because you can sit down with different CEOs, you can sit down with different presidents, different heads of finance for different brands, and their analysis of data will give them a different result because they're looking at it slightly differently in each brand. And so it's important when you're looking at data and then reporting it up to the CEO or CFO that all the brands are looking at it in the same way, or if they're not, at least you're aware that they're not and that you can report that, hey, these are the differences between these numbers.
So, and that's it, you have revenue and costs. So what you're really trying to do from a real estate perspective, you know, you understand what your real estate costs are, maybe what your construction costs are, but that would be, you would be keeping in a silo, you know, for that. And what I think I've heard from each of these guys is, hey, I need to understand what the revenue numbers are, you know, as these stores get up. I mean, obviously you get revenue projections that you put in your pro forma, you know, before you submit, you know, for review. But once the thing's up and operational, you still come back and you kind of review, here was our cost, you know, here's the return we're seeing, how are these doing? So that's where you're getting data from other groups. Is that correct?
Yeah, I mean, into that you can also tie in operational data. So, you know, if a restaurant's not doing well, you're like, let me go in and see what's happening. How are customers kind of going in and what's their experience? Has the management team changed out? And if it has changed out, why have they changed out? You know, you can then go to the head of operations and go, why did you change that manager out? Well, he was a bad manager. Oh, now I understand why the restaurant's not doing well. It's not the location, it's the operational piece.
Yeah.
Yep.
So that was kind of the part of this. I'm going to ask a question and kind of open it up for the audience. But and this is kind of a general for each of you. So think about back on the terms that a metric could be, I need you to open, you know, 60 stores a year. And so you could go tell your real estate construction team, let's go get 60 stores opened a year. And, you know, in November and December, you know, you open 30 in November and 30 in December and you met your 60 a year. Or you could open 5 a month, you know, for 12 months to get to your 60. Talk about the whole idea of store operating weeks and how important that is to creating value versus just the metric of 60.
Well, I think the longer, you know, obviously the longer the store's open, the more contribution it makes is from the top line to the organization's plan for that year. I think the other thing, even probably more important in store weeks, is you got to measure the organization's capability to open stores. You can't open them all in 2 times a year, and if you've got numbers of 60 on a base of 200, you know, you need to understand that piece of it. But financially, there are definitely benefits by, and then I think you're going to open the stores better. They'll have better outcomes because you won't be constraining all the different results. So when the customer does come in, then they'll have a better experience. And once, especially in restaurants, like Sook knows, is once, if the customer has a bad experience, it's hard to win them back. But I think financially, the store weeks, but then there's other benefits as well.
Geno?
I think many times early on in someone's career, particularly at the deal maker level, so to speak, the real estate manager level, oftentimes it's a numbers game. I'm tasked with opening 15 or 20 stores as part of my contribution. And over time, you ultimately learn that it's not just about the numbers. And so clearly, the more balanced you are throughout the year, the better. But it's also important to understand the impact that opening stores too many at a time and how that influences or has a negative impact on the organization. So when you think about retailers who have a very complex operations team member buildup, if you will, then it's critically important that you understand what it takes to staff an organization, to staff at the store level. So spreading out stores not only quarterly and throughout the year, but also regionally, because oftentimes the local operators, human resources, and others have to do a lot to prep those stores so that they'll open successfully. So I think that's one thing to consider as well, the capability.
Sook, any last words of wisdom?
What they said.
That's cheating.
Let me open it up for questions. Anybody have questions? Yes.
Going back to Sook's slide here, and leading your staff internally and reporting to the C-suite, being transparent and managing perceptions can sometimes steer you in opposite directions. Sometimes you have to be a little bit more obscure than you'd prefer for the sake of managing perceptions. And it's a very fine line. So where do you tend to lean in managing your staff versus reporting to the C-suite? And are you sometimes a little bit more transparent?
Yeah, I think, sometimes it is difficult to deliver messages to CEOs and CFOs that they may not want to hear. And I think it's all down to your relationship. So depending upon the relationship you have with your CEO and CFO, that depends how transparent you can be. Because you can discuss an idea with them and it not be going all the way to 100% and say, what do you think of? Rather than, this is what I recommend. And kind of touch on discussing an area that you may want to be gentle about touching, but I think it all depends upon your relationship with the CEO and CFO, because if you don't have that relationship, you can't get into those kinds of discussions. And then when it comes to the team, I think we all have a responsibility to our teams, but I think we found out, really we did in 2009, 10, and 11, sometimes you have to make really difficult decisions around your teams because the business just demands it.
Other questions?
I want to get it so because we're recording. So there's been a lot of talk lately about Amazon and the Amazon workplace and people crying and everything and that type of thing. And the reference basically was to the tyrant CEO, the tyrant C-level. Have any of you guys had any experience with that? And then how did you handle it?
Different CEOs receive information different, and how you be transparent is really based on their personality types. And that's what Sook is really saying, is really know them. But you gotta, if you've got someone that can be a little bit rough, then you need to recognize that person's going to be a little bit rough and be prepared. I don't think you still need to, maybe do things differently, and hopefully it doesn't affect your leadership style, because sometimes it can when you have a boss that doesn't, isn't going to help facilitate your leadership. But I think you just, you just got to recognize what their personality is and what their style is, and you'll just have to deal with it. And ideally, we're not in a situation where we have to do that. How I make decisions of where I go and how long I stay to work somewhere is oftentimes related to how what's the leadership like, and how's that CEO manage. But it's what they got to see. But usually, that maybe hopefully those guys don't get to those levels where that much of a problem. Some have.
So yes, you had one.
I've had different levels of. Yeah, I've had a difficult boss to work for, probably at the C level. But it's. I think everybody's had different experiences.
I think the challenge really comes when they don't understand the industry. So when CEOs don't understand real estate,
Yeah.
they think it's taking too long to make things happen.
Yeah, it's good.
So, like, what is it today? It's September. If somebody said, build me 100 restaurants next year, I'd say, it's not going to happen. It's just not going to happen. There isn't enough time. But if a CEO doesn't understand that, he thinks you're being difficult and that he can make it happen through his will. Well, he can't, because timing just isn't there.
Other questions? All right, we appreciate everybody's time.